Hi, and welcome to our online class for September 6, 2011. Today we're going to take a look at financial disclosures, and we're going to reference Amazon's 2010 annual report as we go to help us to understand what we're talking about. We'll get a visual representation. So we're going to talk about disclosure notes today, and if you're looking in your text, it's part B of your textbook, and it's on page 124. Disclosure notes are a part of the annual report. They're considered just as much a part of the annual report as you would imagine a financial statement to be. They explain and elaborate upon the financial statement. So if you're looking at the balance sheet and you have cash there and accounts receivable, land and buildings, it helps us to understand what all goes into those numbers and what's behind the word land, what's behind the word cash. The full disclosure principle from the conceptual framework requires that financial statements provide all material relevant information, and there's a lot more relevant material information than just cash is, say, $1 million. You want to understand what's making up that cash. And if you're looking at things like land, you might want to know where those pieces of land are, how long you've had them, if you're looking at equipment, if it's depreciated, if it's a lease, all that kind of stuff. So we're going to go ahead and take a look at Amazon's annual report. I'm going to switch the screen to their annual report. So you can see here this is Amazon.com Incorporated, a Form 10-K. A Form 10-K is another name for an annual report. That's what the Securities and Exchange Commission calls it. So if you look through here, it talks about business, the risk factors, all kinds of information. If you get way down here to Exhibit 15, you get financial statements and schedules. I'm just going to page through a little bit with you. We can start with part 1 that talks about the business. They're going to talk a whole bunch about everything that they expect to happen. This is all forward-looking. They're going to talk about their data until you get to management's discussion, and that's management's opinion on what's going to happen in the future. And then I'm going to go ahead and jump. I'm going to use the screen over here and just jump down to the financial statements. So it starts up here with going backwards, as you can see. We are looking for the financial statement. So here we go. We start with the auditor's report, and then we have financial statements. So the statements of cash flow, and then the income statement, also known as the statement of operation. You can see here they're showing 3 years for comparative purposes, the balance sheet, and equity. And then we come to the notes to the consolidated financial statements, and that's really where our PowerPoint is going to focus on the notes. Disclosure notes follow the financial statements in an annual report, so I just showed you that. We had the financial statements and then the annual report. They explain and elaborate upon the financial statements, and the full disclosure principle requires that they provide all material relevant information. The first thing we usually find when we look at disclosure notes is the summary of significant accounting policies. That is usually the very first note that you find, and it really talks about when auditors can make a choice, so that both choices or both methods are GAAP, generally accepted accounting principles, and they're both fine to use. But what happens is if someone is wanting to compare two companies or have a better understanding of what's happening in the financial statements, they want to know which of these methods they're using. So if we think about depreciation, you know that you can use straight line. You can use sum of the year's digits. You can use all kinds of different things that are fine choices and are both GAAP methods. They talk about inventory methods. You may have heard of FIFO and LIFO, last in, first out, and average cost. These are fine methods that you can choose any one of them as long as you use them consistently. But we want to know if one company uses FIFO and one company uses LIFO, that'll make a difference to their income statement and the balance in their inventory. Also, there's different ways to do accounts receivable and the allowance method, the allowance for doubtful accounts, and also what is a cash equivalent. We talk about cash equivalents in this chapter. And when I come back from Disney World, we're going to talk extensively about cash equivalents. And in this section, we want to identify how do we decide what a cash equivalent is in our company so that people reading the financial statements have a good understanding. And if we want to look at Amazon's financial statements, we'll go back there. And we're going to stay here where it says Description of Business and Accounting Policies. And you can see that we have inventory right here. So Amazon says they use the FIFO method for valuing inventory. We talked again about allowance for doubtful accounts. So they have here about how they do it. So they use based on troubled accounts and historical experiences. Here we have depreciation. So we talked about depreciation. And they're going to say fixed assets include furniture and fixtures, heavy equipment, infrastructure, internal use software, and website. And they do it on a straight line basis. So they're using a straight line basis rather than an accelerated method. So there are some examples of the different types of things you can choose from and some of the different things that Amazon actually chooses from when they go through. Go back to the PowerPoint. Other disclosure notes. There's other disclosure notes that don't deal exactly with choices that you're making between methods, but just more information. Pension plans are usually included. A lot of times this deals with whether the pension plan is funded and whether it's underfunded, which unfortunately we may have seen a lot of since 2008. Leases can be capital or regular, more like a rental. Long-term debt, oftentimes we want to know how many debts we have, like what kind of different ones do we have, when do they mature. If a business has a lot of debt maturing, say in 3 years, that may be of a concern to an investor, especially since management should be looking ahead to get some cash reserves or to refinance there. Talking about investments, some of you might have remembered way back with the troubled asset relief and some of the TARP that the government was doing, and a lot of it's settled here on the fair value of the assets. So we wanted to figure out what is the fair market value on the exchange of investments, and this section will tell how they do that, whether they use the fair market value or not, the structure of the investments, long-term, short-term. Here we have income taxes. Income taxes, I'm sure as you know, for your own personal taxes are complicated. Corporate income taxes are also complicated. Here they would talk about obligations. They may talk about timing differences. They'll just discuss in general their taxes. Property, plant, and equipment. Oftentimes they'll discuss at length what type of property, plant, and equipment they have. They may talk about the age of the asset. They may talk about their long-term capital expenditures. They may talk about a great number of different things there. Employee benefit plans are usually included, and that can be anything from how they pay and their medical and all that stuff to more benefit plans for highly paid individuals. And also legal proceedings. So any legal proceedings that are against the business, or even that they're in against someone else, will be highlighted here in the other disclosures. And if we just go ahead again back to Amazon's financial statement, I'm going to go to page 53, and we can see here we talk about the fair value of financial instruments. So it says fair value is defined as a price to be received to sell an asset or transfer liability in an orderly market. So they can talk about their 3 levels of valuation and how they are taking care of their assets. If we go down a little bit more, we can see, hold on one second, I'm going to check the page number, 55. We go to page 55. They're going to start to talk about foreign currency and accounting pronouncements. So they're going on through anything that can affect the company. Here is an example of what makes up cash. So you can see they're giving us a very detailed money markets, equities, and U.S. government agency securities, asset backs. So they are giving you a very full accounting in December 2009 of what they held in cash. Here's fixed assets. They're going to give you more information about what makes up that fixed asset category. This is Amazon, so this kind of makes sense. Fulfillment, they're sending you their package. And infrastructure. And here you have software. A lot of what they do to get the packages to you depends on their internally developed software. And then you can see they also have the depreciation associated with the asset so that you can look at that very closely. Here they're going to talk about acquisitions, goodwill, and intangible assets. Tangible assets are anything that you can't touch, but may include things like copyrights and patents. Here's our long-term liabilities. They're going to talk about financing leases and construction liabilities. But right now I'm going to switch back to the PowerPoint, and we're going to go to the next slide. And we're going to talk about subsequent events. Subsequent events don't always happen. They won't be in every annual report. The Amazon report that I was showing you doesn't have a subsequent event. But a subsequent event is a material event that happens after the fiscal year end but before the financial statements are issued. And sometimes that's confusing to students, but if you want to think about it, let's just say that Amazon has a December 31st year end. So on December 31st, they'll close their books and they'll no longer record any transactions. However, it is a timely process. It takes quite a bit of work to get all those transactions into a usable format, and then it also takes time for an auditor to come in and review the financial statements and do their audit report. So before the financial statements are issued, before the auditors sign off on them, and when the fiscal year ends, there's probably a good few months in between there. And events can happen in those few months. And what we want to do is we want to remember the full disclosure principle. If we know that something happened, something that's material, do you remember the definition of material from Chapter 1? That means that would make a difference to a user's decision making about the company. So if there's a material event that happens and we know about it, the full disclosure principle wants us to tell them as soon as possible. The information should be timely. But we don't want to record events that happen in the following year because of periodicity. So we just really want to talk about them in the notes to the financial statements. Subsequent events can be used to clarify an event and record it properly. So let's say that Amazon was involved in a lawsuit and they're being sued, and on December 31st the jury was still out, we had no decision, and then January 15th the jury came and said that Amazon was guilty and that they would have to pay substantial fines and penalties. Well, then we know before the financial statements go to print, before they're issued here, that they're going to have to pay some money. So it may not be that you're going to record the event for the next year, but you can certainly clarify how much is owed, and you may even want to create a liability, a contingent liability. Material events should be disclosed in the notes of the financial statement. Some examples of subsequent events that you would disclose would be the sale of a business, the issuance of debt, the sale of assets. And as I am working on this screencast for you, I'm waiting to see if Hurricane Irene is going to hit any of the East Coast. And I hope that all of your family and friends are safe. But the type of natural disaster that might take out a warehouse or a plant or inventory would be something that you would disclose in a subsequent event if it happens after the fiscal year end, but before the financial statements are issued. Again, we don't have one of these this time for 2010 in Amazon, so there's not one that I can really show you. The next slide talks about noteworthy events and transactions. There are a few of these. These don't happen all the time. In fact, as you look down the screen, you might say to yourself, yeah, I hope not. The most common is a related party transaction. A related party transaction means that a business or individuals are related to one another.